Today we are going to focus on the financial statements of a partnership. Now, the first question that you may ask is, well, how does the financial statements of a partnership differ from those of the sole trader that you are used to? Well, they are basically the same. There are only one major difference, and that is the equity section of the balance sheet now, other than just capital, also include the current accounts of the partners. So whereas a sole trader only have capital account for equity, that of a partnership have the capital accounts of the partners as well as the current accounts of the partners. Let's just ask ourselves what the purpose of financial statements are. So financial statements includes the balance sheet, the income statement, and the cash flow statement. In grade 11 we are only focusing on the balance sheet and the income statement. In grade 12 we will focus on the cash flow statement. So now that we know that the income statement and the balance sheet are the financial statements that we are focused on, let's get back to that question of purpose. Well, we can also look at the definitions of those two financial statements to even give us a further hint of the purpose. The income statement is basically about whether the business or the partnership in this case made a profit or a loss for the financial period. Usually we work with a financial year. So it's about the bottom line, the last line on the financial statement, namely the income statement, is whether we made a net profit or loss for the year. Whereas the balance sheet is about our assets, our liabilities, and our owner's equity. So the balance sheet is basically about the financial position of the partnership. In other words, to what extent do our assets, for example, cover our liabilities? What is the equity in the business? And we know the equity is basically the assets minus the liabilities. So the equity is what do we owe the owners of the business. So now that we focus on the definitions, let's get back to the purpose. So the purpose of the financial statements is to basically aid in decision making, whether it is internal or external. Like internal, like the partners will definitely want to know what profit did they make, how much can they will be allocated to each partner, is the profit that they generated from the partnership more or less than what they took out of the partnership in terms of drawings, and in terms of the agreements of the partnership, such as how much do they have available after their salaries and bonuses and interests, etc., are deducted. Then when it comes to external users, it might be like banks or other financial institutions will definitely be interested to see, especially what the financial position as reflected in the balance sheet is for the partnership. If the partnership is interested in obtaining loans, it wants to see to what extent does the business have equity versus debts. What proportion are the debts of the total asset value? to what extent does the assets cover the liabilities? Especially to what extent does the non-current assets cover the non-current liabilities, since loans are usually a long-term kind of thing. Then suppliers might also be interested to know the financial position of the company, because they are more interested whether the company will settle its debts in the short term. So they will look more like the current assets versus the current liabilities. To what extent does the current assets cover the current liabilities? Then some SARS might be interested in the financial statements. Actually not that much for partnership. They are mostly interested in companies, but yeah, maybe a potential partner might be interested in the financials in order to make a decision whether he or she wants to become a partner or not, in joining the partnership or not. So yeah, the financial statements basically helps to make decisions. That's the purpose. So now that we know the purpose, let's focus on the structure. So first, the income statement. One thing that we need to contrast between the income statement and the balance sheet is the income statement is over a period of a year, normally a financial year. So it shows flows. Okay, so whereas the balance sheet is more like on the last day of the financial year, so it's more like a picture that's frozen. So where you can think as the income statement as flows over a period of time, the balance sheet is on one particular day, so it is a photo that's frozen. So the position can change radically within a day. Let's say it was the last day of your financial year, and over the night your buildings burned down. Then on the very next day your financial position will look very different, because your assets will be quite reduced.